I want to begin by asking what explains the volatility in the markets today?
No, in fact, again, after seeing the recent lows, after like the corrections you saw in the last, 1 week, the markets were trying to again gain back those levels of 19,800, 19,900. But then, today's action clearly shows that the market may not have more legs up. In fact, this also shows a bit of weakness. So, my belief is that possibly we can again see the markets correcting and go more towards those 19,200 levels than 19,800, 900 levels.
All right, let's also quickly see the top gainers and losers for the day, Suyash, and the sectors that you were tracking this afternoon.
So, Shweta, let's start with the gainers first. Among the top gainers today was Hero MotoCorp, which was up about 3.88%. The stock has been under pressure, so I think we are seeing some bottom fishing in that particular stock. SBI Life was also among gainers today. It was up about 3.62%. Cipla, which has been in the news today, lately because of BlackRock buying the entire promoter stake in the company by next week. So that has also been among the gainers, and it was up to 3.2% today. Tech Mahindra also featured among gainers today. It was up about 2%, and Tata Consumers ended with gains of about 1.22%. Now, among top losers was Adani Enterprises. Adani Enterprises reported a healthy set of numbers, and it has been among the top gainers in the Nifty pack in this financial year. So perhaps there was some profit booking in today's session. Hindalco was another one. It disappointed the streets with its results, and as a result, the stock declined about 2.14%. Mahindra and Mahindra saw some profit booking at higher levels. It was down about 1.8%. Divi's Lab and Nestle India also ended today's session about 1.5 to 1.2% lower.
All right, let's quickly understand what's hurting some of these stocks. I want to begin by asking about Adani Enterprises. What's happening here, Amrish?
No, in fact, we had seen interest coming back into that group, and especially Adani Enterprises, Adani Ports, basically because of major institutional investors buying into these companies. But then I think the good earnings is already there in the price, because we have seen the stocks performing extremely well over the last 3 to 4 months. So I think post the earnings, it's quite natural that you will have some amount of profit booking coming in, and that's exactly what we are seeing.
Amrish, is it fair to say, because Adani Enterprises has run up about 50% in the last 2-3 months or since the beginning of this financial year, so is it fair to say that the concerns raised by Hindenburg have taken a backseat and investors are once again focusing on the financials of the group?
Absolutely, because like reaction we had seen because of the Hindenburg report, that's, I think, a story of the past. And especially because you have some of the very large institutional investors showing interest, I think that's taken a backseat, and people would clearly look at the sort of, the future of the group in the sense the sort of a growth which we have seen in the past. People are expecting that to continue. And with fresh money coming in, I think clearly the view is changing for the better.
All right, and Hindalco, of course, down on the back of results that really, that were below the street estimates, disappointing a lot many people. But let's also, before we pull in those numbers, let's also quickly understand some of the sectors that you were tracking, Suyash, this afternoon.
So Shweta, the banking sector, if you can have that on the board, yes. So Nifty Bank and Nifty PSU Bank and Nifty Private Bank outperformed the benchmarks, and it ended with gains. Nifty PSU Banks was the top gainer in among sectoral indices on the NSE. It was up about 2.71%, whereas among losers was Nifty Metal, which again we saw the decline can be attributed to the fall in prices of Hindalco and which disappointed the streets. Auto also saw some correction, and FMCG sector was also down in today's trade.
All right, so PSU Bank up 2.71%. Let's go to Hindalco particularly. Hindalco results, Amrish, how are you reading the numbers here? Net profit down 40.4% year on year.
No, in fact, these sort of results were expected by the markets, no doubt. And although the earnings were slightly below market expectations, we have not seen a major cut, because, like I said, these sort of earnings were expected by the markets. So I really don't see the stock cracking much more from here.
Okay, and as you said, you know, the result is somewhat in line with expectations, not subpar
Right.
expectations. What's hurting Hindalco and its business?
Clearly, like the sort of rise in metal prices which we have seen 18 months back, and post that, following 2 or 3 quarters, or I think nearly 4 quarters, we saw excellent earnings from most of the metal pack. I think that's the story of the past. And even recently, because of the expected SOPs for the Chinese economy, it was expected that the metal pack should start performing. I think that's been shortchanged again. And I really don't see the metal prices going up from here, especially steel and like aluminum. So I think even at these levels, I would suggest that one should be booking out of the metal pack, because the best seems behind them for at least for the time being. I mean, if you're talking of the next possibly 4 to 6 quarters, I really don't see metals performing.
All right, not very positive outlook there on metals. Yes,
Shweta,
Suyash.
although the results largely disappointed the streets, there were some positives with Hindalco's results. Now, Novelis, which is the aluminium subsidiary of the company, reported a sequential improvement in quarterly EBITDA and EBITDA per ton, which reflects a favorable product mix. And also the copper business, it achieved the highest ever metal sales. It was up 1% sequentially. So there are some positives coming in from the management commentary also.
All right, some positives coming in for Hindalco, but the stock there, of course, down by over 2%, 2.33%, if I'm correct on that number. But let's move on to another important earning that we're tracking, and that is Adani Ports. Very surprising numbers, good numbers there, Suyash. Let's quickly pull those numbers up.
So Shweta, the numbers were ahead of the street's expectations. Now Adani Ports reported the net profit surged about 82.6%, whereas revenue was up about 23.5% on a year-on-year basis. Now one of the things that contributed to such a good push in the revenue numbers was the positive impact from additional revenue generated from fresh acquisitions. Now, if you remember, earlier in the year, Adani had paid 1.2 billion to acquire Haifa port, the second largest port in Israel. So that has positively contributed to the revenue figures and the profit figures. And if we see the EBITDA numbers, the margin jumped about 19%. So 1900 basis points jump in the margins on the back of fresh acquisitions for Adani Ports.
All right, Amrish, I'm looking at the overall Adani story here, and I'm looking at all the results that have come out. It seems worst is over for Adani, and the doubts, the fears around Hindenburg, they seems to have somewhat put to rest by brilliant numbers that the group has reported.
Absolutely, because I think as far as the financials are concerned, they seem to be back on track for the Adani Group. Even for Adani Ports, I think they've clearly reported the highest ever quarterly port cargo volumes. I think there's a 12% jump Y on Y. And if you look at the market share of Adani Ports, it's about 26% for this quarter, which is again a 200 basis points increase. So overall, this company is doing extremely well. The group is back on track. But at the same time, we should remember that the valuations are not really too cheap. Because again, the sort of a move which we have seen in the last 4 months, they are back to those slightly expensive levels, but then liquidity is chasing them, so the stocks can go up some more from here.
And Shweta, also in this particular quarter, Adani Ports has reported the highest ever quarterly jump in cargo volumes, in EBITDA, in revenue, and this was despite the fact that Biparjoy cyclone affected the port business of the company, and almost 50% of the capacity was affected for about 6 days. So despite that, we are seeing a good set of numbers coming out.
So a good freight movement?
Good freight movement, good jump in cargo volumes, as Amrish also mentioned, a 12% year-on-year jump in the container segment also grew by about 15%.
All right. What's your view on Adani stock at the moment, Amrish?
No, like I said, because there's a decent amount of liquidity chasing these stocks, and with the institutional interest, there is a possibility that we could see these stocks going up at least either 5 to 8% more from the current levels. But like I said, remember, the stocks are not cheap. Adani Group stocks are not cheap.
Adani Group stocks are definitely not cheap, but Coal India is another story that we're tracking. The numbers are not out just as yet, but what are the expectations, Amrish, as far as Coal India is concerned?
See, Coal India, I think, should come out with slightly weak set of numbers because of the low e-auction premiums. I think the profits can fall about 30%. And this again is also because of the higher wage cost, which they are incurring right now. And we could also see the revenues declining, to a certain extent. I think the revenue decline could be about 2.5% to 3%. Margins should decline about 500 basis points. But I think as long as the earnings are as per these figures, I don't see a major cut because this is what is expected. But in case they are much weaker than here, yes, I think we can see a cut.
Amrish, the markets have been largely volatile over the past couple of weeks. So, what are some of the factors that will drive interest in the markets or away from it in the course of this week?
In the course of this week, I don't see any major, sort of news items except for the RBI news as to whether they increase the rates or not. But my feeling is that they may actually have a status quo on rates. So that again may not really have too much of an effect on the markets. So I think they'll just about hold on or possibly correct, like I said. I don't see much of an upside from here because I don't see too many other triggers coming in because most of the earnings are, getting over, the important earnings are over. And I don't see any major triggers as such. I think the other negative trigger which can possibly happen is the oil prices, which are still, continuing to move up.
So, Amrish, let me put you on the spot over here. What will we see first? Nifty touching 20,000 or falling back to 19,000 levels?
No, like I said in the beginning of the show, that I really don't see the markets going beyond that 19,800, 900 levels. And I think we'll first see levels closer to about 19,200 than 19,900.
All right, Amrish Baliga, Suyash, thanks very much, gentlemen, for joining with your inputs. And we will, of course, keep bringing all things market as of tomorrow morning. But appreciate you both taking time out and for joining us on this extremely important discussion. Shifting focus now. E-commerce startup Meesho has posted a profit for the first time ever and is planning to list in the next 12 to 18 months. The company posted 43% growth in orders and 54% growth in revenue in the last 12 months. Now, Meesho did not, of course, come out with its numbers, but only hinted at making profit for the first time. Now, Meesho competes, remember, with Amazon and Walmart's Flipkart. It's a fast-growing e-commerce market. It targets smaller towns and cities and was last valued at nearly $7 billion. Its valuation since has come down. US-based Fidelity Investments cut Meesho's valuation by 10% to $4.4 billion as of May 2023. Now, Meesho joins a long list of startups whose valuations have taken a hit. At the same time, it also joins a limited number of startups that have turned profitable very, very recently, joining, of course, the like of Zomato, for instance, that recently turned profitable. To discuss profitability and valuation, let me call in my colleague Amit Kumar Ranjan, who has, of course, documented some of these startups and their journey for profitability, their inflated valuation. Before we play up that important documentary, in fact, two documentaries, Amit, that you've made on the subject, I want to first begin by understanding in this debate of profitability versus valuation, which one takes precedence?
Profitability can wait because like the documentary will tell you, and most of the talking heads in the documentary will tell you, startups in a very competitive space are covering a lot of distance in a very short period of time. And in that endeavor, they need constant infusions of money for a lot of things, marketing, customer acquisition and all that. So profitability comes late, but valuations are more important. So that takes
valuation takes precedence over profitability. Let's quickly play up that documentary before we delve deeper into this debate.
Join the gang, join them and become rich, become a billionaire.
It's like a pyramid scheme. You look at the unicorns and see how many are profitable today, then you worry. How long can they sustain? How long can they last?
ultimately is to become a business, you have to be profitable.
Is profitability the only metric? Not really. Value creation is the metric.
It's a slippery slope and you may kind of really get carried away with your fast growth or growth at any cost.
So what's the real Shark Tank? If you were to understand that, I think it's important to understand who are the sharks in that Shark Tank. And the shark is not always profit. The shark is not always market. The shark, more often than not, is not even your angel investor or the venture capitalist who has taken an early bet in investing in the business. The real Shark Tank is the purpose of every business's existence. And that is creating value for investors.
It's very simple. A founder really believes in something, he's passionate about it. He picks up his four people who are equally mad like him to kind of really start something.
It's an idea which tries to get a larger space in a relatively shorter amount of time.
Let's jog our memories back, 75 years or so. 1957, there was a group of 8 founders that later got referred to as the Traitorous 8. And why the Traitorous 8? Because these 8 people quit their existing jobs at Shockley International and started what perhaps in modern lexical could be referred to as the first startup of sorts, Fairchild Semiconductors. And arguably so, this was the first company that became a disruptor and an innovator and created a whole body of integrated circuits and transistor chips that we see the world of IT really riding on today.
The startup market historically has gone through many cycles, and there are cycles where cost of capital is low, funding is easily available, a lot of companies get funded. And see, the startup model is designed for to accommodate a lot of failures. Why failures happen?
A lot of startups start with an idea which they have, a product which they want to build, and they have not thought through our distribution and the payers. And that's where the mortality happens. So it is not about that greed of making money fast and not building institution. I don't think that's the reason for mortality. The mortality is, am I thinking outside in or I am thinking inside out?
A startup has to focus on the customer, understand the customer data, customer insights, because they are looking for product market fitment. Once they figure out the product market fitment, they have to get the operations in place. So that is where, the supply chain becomes important. Then they have to sort of go to a larger market. They have to build a brand and have a brand recall. So branding becomes important. Once they have figured that out, then they have to start growing the top line. So revenues become important. And ultimately, is to become a business, you have to be profitable. So profit become important then.
Well, I guess I'm old. My generation, in my times, I feel very uneasy. Because what mattered was a good business plan which showed, not immediately, not tomorrow, some things take time, but showed profitability somewhere down the line in a very sensible way. Today I look at business plans and they're looking only at top line, how I can grow my revenues, 2x, 3x, 4x, 10x.
Risk is there in every business. Who would have thought in January 2023 that business models of Google or business models of Microsoft can be disrupted? You have a chat engine, chat bot called ChatGPT. Again, developed by an AI startup, OpenAI. Was it profitable? No, it wasn't profitable. How did it survive Shark Tank? Because of the investment that Microsoft made into it, it ended up creating huge value for its original founders.
A startup entrepreneur is interested in becoming a billionaire, in creating a unicorn, in creating a decacorn, in creating whatever cons they want to create. All of them want to be rich. Is there anything wrong in it?
I think from the first funding round, typically 5 years is what we see when investor asks for, and that's a very fair amount of time for startups to turn profitable.
If you look at edtech, like one of the biggest companies in the edtech sector, I think to acquire a customer, they are spending as much as they are earning, right? So the customer acquisition cost is very, very high for them.
PayPal is a globally recognized payment gateway today, but how did that journey really start? If you look at PayPal in the late 1990s, that was the age of Palm Pilots. Did it do well? No, it did not. There was innovation at play. PayPal actually did not find its market until it introduced something that today we refer to as cashback. So PayPal was willing to offer a cashback of up to $10 per transaction in a bid to acquire more customers.
Is profitability the only metric? Not really. Value creation is the metric. And that value creation and value realization at the end of the day. So I'll give you an example. For example, when YouTube was made or Instagram was made, extremely valuable loss-making properties. They found the right homes in Google and in Facebook, and those companies had the infrastructure to monetize it in a beautiful way. So it's not that because that was not profitable, that is not valuable.
It's like a pyramid scheme. I'm not saying this is intentional, I'm not saying something's happening there, but people get caught up in this, and many young people who have very exciting ideas or dreams in their eyes suddenly begin to read headlines and box items of how somebody sold their company for X million dollars, how some investor came and put in so much money, how some company became a unicorn. You look at the unicorns and see how many are profitable today, and then you worry. How long can they sustain? How long can they last?
Now, what happened to PayPal? Of course, Elon Musk invested at the boom of what was called as the tech revolution, Y2K year, the year 2000, iconic year for IT, and that sort of merged with X.com. What happened in 2002, just 2 years later? Did PayPal become profitable? No, it did not. It eventually got sold to eBay for $1.5 billion. Now, 20 years later, does PayPal really need to worry about its profitability?
First, you have to make sure you survive. So what does that mean? You have to go and fundraise. Fundraise cycles keep shifting. Sometimes it's GMV, sometimes it's unit economics, sometimes it's market share. It's just and you keep iterating your business to be in sync with the short-term requirements of the market.
Few people are building companies for a generation, or building it because they want to be in that area, or building it to say, hey, I'm planning this in a way that 4 years down the line I'll begin to have profits.
I don't think a founder typically starts a business that I want to get acquired. Typically, a lot of time it's driven by venture capital funds, right? VC funds who have got and we have seen that cycle, right? Kind of who actually get specific things signed up, right, with you. I don't think a typically founder would start a business to get acquired.
Amazon was a startup, Google was a startup, Facebook was a startup. A company that starts and till it gets to a stage where it can sustain itself over a long period of time, that is the destination. Now, the way it works is that a lot of startups, usme you need funding right up, and investors put in money, and those investors seek or need an exit, and then they invest in other companies of the early stage. So that is the exit part. So exit is a financial outcome. It's company's journey continues.
What is the purpose of these startups really? These startups, of course, while being risky, while being non-profitable, while being highly invested in ventures, they're typically serving the job of being technology laboratories. And is their end goal really to stay in the business and make money by virtue of profits? Or is the purpose really to not really worry that much about profits, but worry about the next big company which can acquire them and yet serve the same purpose that it started with of maximizing shareholder value?
This is a very new situation that is coming, where there will be global monopolies or near monopolies with 2 or 3 big players who are going to dominate, because they will have an unfair advantage. That is why the biggest danger to all of us are digital monopolies, global digital monopolies. Microsoft is a global digital monopoly in B2B. Salesforce.com is another digital monopoly.
I have worries, but I told you I'm old generation. This new one, but does worry me, and I don't want to paint everybody the same brush. That would be grossly unfair. Many entrepreneurs are fantastic. They're committed. They want to make profits. They will. Many have. Some companies have proven in a few years they've begun to make profits and are doing well.
There has been a reasonable shift in the investor mindset. People who are writing free checks for just product market fit are asking tougher questions on unit economics and are asking for far more tangible roadmaps to profitability in general. So one of the big stories which I think will come out on the Indian ecosystem 3 years from now or 5 years from now are not successful unicorns but successful wildly profitable unicorns. We are hearing of D2C companies who are getting to profitability as a company at the 100-200 crore mark, right? This was unimaginable 3 years back. There was a saying that you needed to be 2000 crores revenue to be profitable. So I think the full ecosystem is rebooting to a new environment where profitability is far more important.
We really started with the story of, what is referred to as the traitorous 8 and their startup Fairchild Semiconductors in 1957. Now, by 1960, it had become a Silicon Valley incubator of sorts, and it was directly or maybe indirectly involved in creating dozens of incorporations, including the likes of Intel and Advanced Micro Devices. In 2016, it got acquired by ON Semiconductors for $2.4 billion. That, I think, in a nutshell, is a classic example of what a startup story really looks for. You sustain over the decades, you run after evolving technologies, you keep reinventing yourself, but at the end of the day, it may not be always as much about profits as it would be about creating value for shareholders. And that is the real Shark Tank that startup entrepreneurs are trying to survive in day after day.
All right, that documentary is available on News9 Plus app for you to download and watch. There is one more to that. We'll come to that in just a bit. But borrowing from what my colleague Karthik and Mr. Tandon from Tata 1MG said, it's not about profitability to begin with, it's about creating value. I think that's the consensus when you speak to all these startup founders, Amit.
Yeah, because creating value is what goes into the rounds of funding that these startups keep on consistently going into for raising funds to go into the next plan of innovations, next round of market penetration. So they need that. So they need the evaluations. What we saw in the documentary, this first one happened in April. We filed it at the end of April. It went on the app in the month of May. Things changed since then. The valuations of some of the companies we have listed over here came down drastically. Byju's was 22. It was a double-decker, more than a double-decker con. It's come down to about 5. So it's it's not even a
$22 billion
decacon.
to $5 billion.
It's not even a decacon anymore.
That of course is the devaluation. But you know what? Let me ask this question from the point of view of an average person watching us out there. It seems a bit counterintuitive to be in business and not make money, to be in business and continue to lose money, to continue to bleed. Because business at the end of it, as is a child taught in school, is about making profit. It's about being in business that can be sustainable. It can only be sustainable if you continue to make money. How do you then explain it to an average person out there saying, oh, lovely, fancy valuations, but at the end of the day, I can't make enough money, I can't sustain, I can't survive, and eventually I'll start getting devalued if I'm not giving as much, again, as much sort of addition or not adding as much value as I was adding about, let's say, 5 years ago, 4 years ago. All of this becomes redundant.
Let me start with the cliche. Right from the beginning of time, every business when it started, in their books they have something as break even. Earlier on times, maybe even at the time of when Mr. Jamshedji Tata put on his first blast furnace in Jamshedpur, there was a break even. Now that till you achieve that break even point, you'll be lucky. Initially, you may not be even having operating profits. So you are in losses. That is the same cycle these startups are going through.
But the cycle becomes way longer here. The concern that many of the experts also have is that the cycle becomes so long that it becomes difficult for companies to endure losses consistently, sometimes 10 years, 15 years, 20 years. A lot of startups that are still not making profit. They're not profitable just as yet. We just have a couple of examples to give which have recently turned profitable. But apart from that, majority of them are still not making profit.
So it's a phase. The word startup itself wasn't in the common lexicon maybe even 15 years ago. So one of the big examples that is given today of a company that is more than about 15 years old, which is not making profits, which is making huge losses, is Flipkart. But then Flipkart went the route of being acquired by Walmart. And that is what happens to quite a few companies which go and get the cushion of a bigger shark, which gives them the cushion to fail again and again, but innovate.
Okay.
The shark startups are, as one of our talking heads said, incubators of innovation. 5 people in a room, young heads focused on the same goal to get something new, to solve a problem in the marketplace and make money out of it. All these things, though sound simple, take time and they take money. And till that time is you have run through that time, you are in losses.
And
so
then if
that
those
is a
losses
phase.
continue to sustain, and if those losses continue to mount, and there is no profitability in sight, I suppose that becomes a problem after a while. Very recently, MobiKwik, Zomato, Meesho, that we started our show with, have turned profitable. But there's another story that is brewing by the way of Byju's, which, as you pointed out, was valued at $22 billion, is currently around $4 to $5 billion. The valuation coming down almost slashed to half is surprising to a lot of people. That, of course, is investors of Byju's who are not valuing their current position in Byju's as dearly as they were about a couple of years ago. We'll also come to that documentary where, you know, you've documented
about the valuations.
You've documented devaluations, you've documented why this sudden devaluation has started kicking in the startup space. Let's quickly turn to that before we discuss this.
Days of glory for startups have unfortunately reduced to days of devaluation.
So any investors who are investing in Series A, B, C are tempering down their valuations because they know there is no investor of last resort to come and bail them out.
Investors love to invest behind companies that are getting the customers' money.
The survey do from a fiscal prudence is to disabuse themselves of the notion that there is always capital available on tap.
Days of easy money have been over for a while, and this funding winter has been a prolonged one. It's finally beginning to chill Indian startups pretty much to their bones. Now, it all started in 2022 with inflation and all the cycle after cycle rate hikes that we've seen across central banks. They've tried to suck out money, and that money has been sucked out from the startup ecosystem and invested in US Treasury bonds, for example, safer havens. Now, what's really happening with this is that these sharks, the venture capitalists, are now swimming out of the shark tank. As a result of this, valuations have been in a downward spiral. Companies like Byju's, Swiggy, Meesho, Ola, Oyo, Farm Easy, they've seen their valuations dwindle pretty much to the trickle.
So when we had a low interest rate environment, which is what we had for most of the last decade itself, it actually prompted a large number of people who were searching for returns or yield to start taking more risky investments and more risky bets. It's why a large amount of money started coming to startups also. But I think what threw a spanner in that works is the fact that interest rates actually started rising, and this prompted the cost of capital to go up, and this actually reduced the amount of capital available.
The other important factor is to note is that bigger players or bigger venture capitalists in the ecosystem like Tiger and SoftBank, who were often the next round of investors and paid unjustified valuations, have also become conservative. So any investors who are investing in Series A, B, C are tempering down their valuations because they know there is no investor of last resort to come and bail them out, which was often the case in 21-22 when SoftBank, Tiger wrote checks of valuations which are often very unjustified and revenue multiples which are unheard of ever in the history of valuations.
So unfortunately, there isn't one crystallized formula for calculating valuations. How do you derive that formula for valuation? Should it be, let's say, 10x of revenue? Should it be 40x of profits? Now, should you be looking at these financials at all when arriving at valuations, or should you be looking only at growth, customer acquisition, cash burn, building the brand? What?
When you look at public markets and you see the prices of shares, they go up and they go down, depending on company performance, depending on liquidity in the market, depending on market sentiment. Private markets are not published every day, the valuations, but the valuations there also are capable of moving up and down on the same parameters.
Valuation ultimately is a present value of future cash flows. Investors expect companies to actually generate cash, and profitability is more important, so that's driving the valuation downturn of some of these bigger companies like Baiju and Swiggy.
And one of these hallmarks of companies who are valued 1 billion and above, especially your unicorns, is that look, you become a fairly large business by yourself. So now you need to end up figuring out a way to balance growth as well as profitability also. And in case a company is unable to actually match that expectation of the market and investors, they will end up actually marking these kind of businesses down and end up moving on.
Decacorns, which are companies with a valuation of $10 billion and above, have become an extinct species almost. And look at unicorns. The rate at which unicorns were getting added to Indian startups every year has come to a halt in 2023. Calendar year 2023, for the first 6 months, H1 has not seen a single addition to the list of unicorns. And why is this happening? Again, this absence of a clear-cut formula to arrive at a real valuation. Eventually, it boils down to a mutual negotiation between an investor and an investee. And what are they both really looking at? The investor is looking at the next potential exit where his or her investments return a handsome profit. The investee, on the other hand, the founder of the startup, is looking for more cash, which increases the valuation at one hand and gives the headroom to burn more cash in a bid to create a brand or acquire customers and define growth in whatever way growth is defined.
A lot of the startups we talked about today have also spent a lot of money on above-the-line advertisement. They've sponsored cricket, they've sponsored World Cup. I don't understand how this helps their fundamental business model, right? So all of these excesses need to go away, and you need to have more sensible driving of business and driving of growth, which, by the way, a lot of companies know. If you today are not a startup, if you're a company like a listed company in the public space, you are delivering returns, you are delivering growth. So I think that's the mantra which startups should follow.
If you are valuation driven and your valuation is based on your sales and top line and not on your profit, right, you will tend to spend a lot of money just to acquire customers and to get sales, never mind profits. Especially if you have competition that is well funded and doing the same thing.
There was this mantra of grow at all costs. So everyone said that, look, if the metrics my investors are looking at are, let's say, the number of new customers I'm getting, or the number of the average transaction value, or the GMV I'm generating from a business, I'm going to study the way I study for exams. I will just answer those 3 questions and damn everything else that goes about running a business. And that was unfortunately the mentality if you look at e-commerce and certain verticals, where the name of the game was just customer acquisition at whatever cost, and eventually they will end up paying and they'll end up becoming more profitable and going about their entire path. So I think there was a race to the bottom that has thankfully ended up correcting right now.
All investors are now very shy in this environment to invest in models which are cash burn models. So today, if you're a startup where you are burning cash for the foreseeable future, you will not find an investor who's willing to invest in you, because his investors, his LPs, have also told him not to invest in cash burn models.
When liquidity gets constrained, as it is now, people come back to prudent commercial practices, and that's what is happening. Right? You are now looking at unit economics. You're looking at EBITDA. You're looking at profits. You're looking at cash flows. These are all good, sound, sensible metrics to look at, and I'm glad the market is now shifted to this.
The stuff we do from a fiscal prudence is to disabuse themselves of the notion that there's always capital available on tap.
I will say what I have always said, which is that the customer's money is better than the investor's money. So if you're getting the customer's money, the investor's money will almost certainly follow, because investors love to invest behind companies that are getting the customer's money.
We'll end up looking at the size of the market and the real addressable market. Not just India as a country of 1.4 billion people, my service will end up catering to all 1.4 billion in 5 years, etc. These are all what I call Excel dreams. These work well on an Excel sheet, but they always fail when they clash with reality.
So I believe this crisis will create stronger companies. We will see far more sustainable companies, companies which look like companies which can be global leaders, and a crisis is the best time to produce companies like this. So companies which survived this funding winter and outlast the companies which can't raise capital will be the ones which are the winners of the future.
Some will die, some will succeed, some will consolidate. Right? But that's a part of the startup ecosystem. Startups are, the entrepreneurial ecosystem is Darwinian in nature. It's survival of the fittest. Not everybody makes it, and that's life. But I see more and more entrepreneurs trying. So I see that in medium term, long term, it will only thrive. But yes, some will fail.
Some will obviously sustain their businesses. They have the runway and the hunger to continue running on that runway to eventually take off. The rest of them will fall short of expectations of their investors and of their customers alike.
All right, that is part 2 of Shark Tank, made by my esteemed colleague Amit Ranjan, who's sitting right here with us. But the documentary was out in July. Since then, yes, we've seen further devaluation. What's happening here?
Take a page out of the quote from Mr. Sanjeev Bikhchandani. There is, because of all the factors, supply chain disruption, Fed rate heights, there is a slump in the liquidity that is available in the market, and therefore the valuations are down. Some companies, case to point the example of Byju's, they overspent, sponsoring the Indian cricket team, the biggest icon as their brand ambassador in Shah Rukh Khan. So they did overspend, and they threw corporate governance caution to the wind. They are taking corrective measures now. So that is a unique case. And in their industry, cost of customer acquisition was also very high.
Okay.
So all those things added up in that particular case. But largely, liquidity is low. When the markets turn around and there is more liquidity in the markets, I believe valuations will come up again. Maybe not to the levels that they were, because there was a frenzy.
But is that a cause of worry? I understand this is happening throughout the market. It's pan-India, if not pan-India, pan-world at this point in time. A funding winter which has lasted beyond winters now. Is that a cause of worry for startups that are hoping to become perhaps unicorns and decacorns in near future?
It's definitely a big cause of worry. But there are so many factors that are beyond their control. I mean, you can't control a war that is happening. You can't control climate that is taking a toll on production and distribution. So those are things beyond their control. It's definitely a cause of worry, no question.
All right, it is a cause of worry, of course, for a lot of startups, but a lot of startups there. Good news also coming in by the way of profitability that they are reporting at this point in time. A handful few, Amit, a handful few, not a lot of them.
Yeah, although Zomato is in profits, Meesho is in profits. I will give you one more good news, that is there is Japanese are investing in Indian going to
Okay.
invest in Indian gaming startups.
Okay.
Almost
Lovely.
50
So
million
we'll
set aside, corpus set aside.
All
by
right. So
them.
of course we'll bring more information as and when that money comes through, that
Yes.
investment comes through. Amit Ranjan, thanks very much for joining with your inputs. We will of course keep bringing more details. But Kiran Rijiju, BJP leader, is speaking in Parliament. Let's cut across to that.
2020 के टोक्यो ओलंपिक जो 21 में होस्ट किए हैं, मगर नाम 2020 टोक्यो ओलंपिक्स पहली बार 7 ओलंपिक मेडल जीत करके लाए हैं। और अगर आप कहानी सुनेंगे अध्यक्ष जी, एक खिलाड़ी के पीछे जो लागत है, जो मेहनत है, पूरा टीम एफर्ट होता है इसमें, चाहे कोचेस का काम हो, चाहे ट्रेनिंग का हो, चाहे पैसे उसमें जरूरत पड़ता हो, पूरा उसमें इकोसिस्टम क्रिएट करना पड़ता है। और आप